The rate for a 30-year fixed interest mortgage has doubled in the last 9 months, topping 6% last week for the first time. This does cause panic among buyers. I'm here to tell you that a hike in the federal benchmark rate might not have a direct impact on the mortgage rates. We get calls every time with some level of panic to lock the rates immediately whenever there is news around these short-term rate changes. It's important to get some basic understanding of the dynamics of these rate changes. See, the Federal Reserve sets its borrowing cost for short-term loans in the US by moving they call it the Fed funds rate. I mean, during much of the COVID time, the Fed kept this rate to almost zero, right? So with trillions of dollars being pumped into the economy, with this rate being set at zero, there was some kind of an imbalance in the market, which right now the Fed is trying to make changes to. So this Fed rate governs how much banks pay each other in interest to borrow funds from their reserves that are kept at the Fed on overnight basis. This has an impact on short-term loans like car loans or student loans or credit card debts, but not directly on the mortgage rates. So don't panic when you see these news on CNBC or any of the TV channels. What you have to remember is mortgages, on the other hand, tracked by the 10-year treasury rate. So the changes to the federal funds rate might or might not move the rate on the 10-year treasury bonds, which are issued by the government, and they take a decade actually to mature. So with that said, the Fed influences mortgage rates through monetary policies such as when it buys the debt, all these debt securities in the marketplace. So early in the pandemic, going back to when the COVID started, there was severe disruption in the treasury market, making this cost of borrowing money very expensive. That's when the Feds actually stepped in, and they did respond, and then they announced that it would buy billions of dollars of treasuries and these MBS, they call it, the mortgage-backed securities. The move then was to support the flow of credit, which helped push the mortgage rates to record lows. So whatever we did then, now we are trying to undo it. That's why you see all these mortgage rates going up and down. Since these fixed rate mortgages are tied to the 10-year treasury rate, when only that rate goes up, the popular 30-year fixed rate mortgage actually tends to do the same, and vice versa. So the rates for the fixed rate mortgages are also influenced by other factors such as the supply and demand. When the lenders have too much business, they tend to raise the rates and decrease the demand, and when the business is light, they tend to cut rates to attract more customers. So all this again is tied to the inflation, like the inflation also pushes the rates as well. So the inflation is low, the rates also tend to be lower. Right now the government says that the inflation is so high. I mean, you've seen it with the gas prices and all the prices of everything. The inflation is super high. So because of that, in response to that, the mortgage rates are also being very high. So coming back to the secondary market, where the investors buy these MBS mortgages or the mortgage-backed securities, they underwrite and sell them in the secondary marketplace to investors. When the investor demand is high, the mortgage rates trend a little lower. So when the investors aren't buying, the rates may rise to attract the buyers. So due to this demand imbalance also, we are anticipating that the mortgage rates are slotted to increase even further before they fall. Like how high? Already we are seeing that the home buyers are going into a panic mode with so much of rate changes that are happening. You should check the historic mortgage rates on macrotrends.net, wherein you can see a chart. We are at 6% right now, and still it's not a historic high. I would be bracing on for maybe 10%. I mean, 10% seems a lot, and I might get challenged on this when I predict that okay, the rates might go up to 10%, but that seems like we'll be there soon, especially because inflation is still very high. While no one can predict the future of the interest rates with any certainty, it appears clear to me that the rates will increase all through 2022. As the inflation continues to batter the economy, the rates are going to go up. So keep checking with us, don't panic, when you see the news articles and the websites saying that the interest rates are high, they are for the short term rates, and the lenders would have already increased the rates for you in anticipation of Fed raising the rates. So don't try to do the panic locks, but at the same time be prepared. Thank you so much. Check back with us.